A federal tax lien and a levy sound similar, but they're totally different actions. A lien is the IRS's legal claim against your property as security for a tax debt. A levy is the IRS actually taking property or money to pay the debt. On the EA exam, they love this wording. Lien equals claim. Levy equals seizure. A notice of federal tax lien can't be filed whenever the IRS feels like it. 3 things must happen first. The IRS assesses the tax, sends a notice and demand for payment, and you neglect or refuse to pay. Once those are met, the lien exists for the amount owed and it attaches broadly, basically to everything you own and to rights to property. Here's the part students miss. The lien attaches not just to current property, but also to property you acquire later. And it attaches to rights to property, like accounts receivable if you run a business. Filing the notice of federal tax lien also makes it public, which is why it can wreck credit and spook other creditors. How does a lien go away? The cleanest answer is, pay the tax in full. After full payment, the IRS releases the lien, typically within 30 days. Exam tip. Release is not the same as withdrawal. Release means the debt is satisfied or no longer enforceable. Withdrawal is more like removing the public notice, and it's a separate request. Now the levy. A levy is the legal act of taking. The IRS can levy wages, bank accounts, and even seize and sell assets like cars, boats, and real estate. Wage levies are especially nasty because they can be continuous. Your employer keeps sending part of each paycheck until the levy is released or the debt is paid. The IRS can't always levy, even if you owe money. Common levy prohibitions include while an installment agreement is pending, while an appeal is pending, during offer in compromise consideration, and during bankruptcy, unless the court allows it. Also, there are extra protections for a main home. Higher level approval is required, and judicial approval is generally needed. Even when a levy is allowed, some property is exempt. Classic exempt items include wearing apparel and school books, certain household goods up to limits, tools of the trade up to limits, undelivered mail, unemployment benefits, and workers' compensation. But watch the traps. Regular Social Security is not exempt, and traditional or Roth IRAs are not automatically exempt either. Finally, levy release for hardship. If the levy is creating severe economic hardship, meaning you can't meet basic living expenses, the IRS can release it. That release doesn't erase the balance due. It just stops the seizure so the taxpayer can survive, and then the IRS looks for another collection path, like an installment agreement or an offer in compromise. Which of the following types of income or assets are not exempt from an IRS levy? The options include unemployment benefits, Social Security payments, undelivered mail, and workers' compensation. Remember, the exam loves to test the one benefit people assume is protected. Think about it. The correct answer is Social Security payments. Regular Social Security is not exempt from levy, even though many people assume it is. A tempting wrong answer is unemployment benefits, because it feels like a protected safety net payment. But unemployment benefits are specifically listed as exempt from levy. Brianna owes over $50,000 to the IRS from an old tax debt, and the IRS has already put a lien on her home. She wants to sell the home, use the profits to pay the IRS, and then move in with a family member. What must she request from the IRS to sell the home and pay off the debt? Think about it. The correct answer is a lien discharge on the home. Discharge removes the federal tax lien from that specific property so the sale can close, often with the IRS getting paid from the proceeds. The tempting wrong answer is lien withdrawal, but withdrawal is about removing the public notice. It's not the standard tool to clear title for a specific sale.